Now let's talk about features of common stock. Common stockholder preserves the right of voting. Through voting, they can select, they can elect the board of director, they can intervene in the company's important issues that matters. For company, any sort of decision, the common stockholder deserve the voting right. Another one is proxy voting. Proxy voting occurs when minority owners are trying to get enough votes to obtain seats on the board or affect other important issues that are coming up for a vote. Apparently, proxy voting is a form of voting whereby a member of a decision-making body may delegate his or her voting power to a representative to enable a vote in absence. The representative may be another member of the same body or external. Sometimes for merger and acquisition, for other decision-making purpose, the minority shareholders may adopt proxy voting strategy to change the management or to gain something beyond the current management. The third one is classes of stock. There is also very important features of common stock. A class of share is a type of listed company stock that is differentiated by the level of voting rights shareholders receive. For example, a listed company might have two share classes or classes of stock designated as Class A and Class B. Owners of companies that have been privately owned and go public often create Class A and Class B share structure with different voting rights in order to maintain control or to make the company a more difficult target for a takeover. Two of the primary types of stock are common share, representing the majority of shares available across the market, and preferred stock, which typically guarantees a fixed dividend but do not have voting rights. Different classes of stock can have different rights, like institutional shareholders. Owners may want to issue a non-voting class of stock, which is preferred stock, if they want to make sure that they maintain control of the firm. Other rights of common stockholder is like when company declares dividend, then share of the dividend are distributed proportionally among the common stockholder. When companies decide to liquidate their business, then the remaining assets are also distributed proportionally among the common stock. Preemptive right. A preemptive right is a stockholder's right to maintain his or her ownership percentage in a corporation as the company issues additional shares of stock to new investors. In other words, this right allows current shareholders to purchase their proportional number of shares in any new stock offering in order to maintain their ownership in the company. Without this right, their ownership share would be diluted every time additional investors were allowed to buy into the corporation. So, a preemptive right is a stockholder's right to maintain his or her ownership percentage in a corporation. Common stock dividend characteristics. Dividends are not liability of the firm until a dividend has been declared by the board. Consequently, a firm cannot go bankrupt for not declaring dividend. A company may declare dividend or may not declare dividend. For this, they will not go to bankruptcy. Dividend payments are not considered as business expense, therefore they are not tax deductible. A corporation's dividend enjoys 70% tax exclusion. Suppose if corporation A owns less than 20% of corporation B stock, then 30% of the dividend received from corporation B are taxable. Suppose if you have 100 shares of corporation B stock, then 30% of the dividend received from corporation B are taxable. The rest 70% are tax exempted. So for this tax advantage, sometimes the investor main choice is to invest in shares for dividend payment. Features of preferred stock. Like common stock, preferred stock generally does not have voting rights. The preferred stockholder cannot do votes for selecting board of directors for decision-making purpose of corporation. On the other hand, preferred stocks can be called as hybrid investments. The sharing characteristics of both stocks and bonds is existed in the preferred stock. Like bonds, they usually make regular fixed payments and have a par value that is returned to the investor when the security matures. So that is why it is called hybrid feature, where you can see the feature of equity, you can see also feature of a bond. Dividend. Here, stated dividends that must be paid before dividend can be paid to common stockholder. The preferred stockholder always get the preference before the common stockholder. If company is not being able to pay dividend for certain year, then they have to pay it in a cumulative percentage after the certain year. Suppose the company for a company's financial inability, they have not paid dividend for year 1 and year 2. But when they decide to pay in year 3, they have to pay cumulative dividend in year 3 before the common stockholder. The missing year 1 and 2 should be the missing year dividend 1 and 2 should be added with year 3 dividend, and that is why it is called cumulative. The total dividend of year 1 year 2 should be paid in year 3 if they miss in year 1 year 2 dividend to provide to the preferred stockholder. So that's all about stock valuation. Stock valuation is very fundamental for share investor before investing in shares of stock. In the present world, we can see the vibrant economy, vibrant share market because of the misleading information, misleading approach from the shareholder and from the company as well. So when shareholder is well equipped with stock valuation, they have the knowledge of stock valuation, they can make a good decision before selling or buying shares of stock. So I think this is a very important lesson for a student and for the person who wants to invest in shares of stock. So thanks for staying with us in this session.